People have realized that the DApp model of just holding Bitcoin doesn't quite work very well because Bitcoin doesn't generate a yield. I think the Ethereum one, the biggest Ethereum one, I think they were announcing they collected, I think, $200 million in staking rewards or something. $200 million a year, you could do a lot of business, or you can have a lot of staff to not do business if you wanted to. So I think that having the staking reward versus Bitcoin where there's no staking reward does make a bit of difference.
That's Ben Tsai, president and managing partner at Wave Digital Assets. He manages treasuries for protocols, including Cardano, Polygon, and Midnight, holding 9-figure digital asset positions. He explains why passive treasury management destroys value when volatility hits. Protocols hold hundreds of millions in native tokens and stablecoin reserves.
One thing that I think people are underestimating is the possibility of using tokenized MMFs as stablecoins. As an example, you and I are transacting in dollars, we black coffee and so forth. Instead of a dollar, what if I can buy with tokenized MMF? I can pay using my MMF, and that means that that money is growing the whole time. The whole idea of my checking account, my cashing account being separate, it's like, well, why do we separate them? It's just an account. I don't care. I want to write checks from it, and I want yield on it. And I want very high yield on it. Or I want like MMF level yield, and I want to write checks on it, and I want to spend it off of my credit card and so forth.
In this episode, you'll learn why tokenized money market funds can replace stablecoins to preserve yield during every transaction, how separating checking and cash accounts destroys returns that protocols need when volatility hits, and what happens when treasury operators stop treating idle capital as a cost center. I'm Alex Nwaka, and this is High Stakes. Welcome back to another episode of High Stakes. I'm your host, Alex Nwaka, and today I am joined by Ben Tsai, who is the president and managing partner at Wave Digital Assets, where he's in the institutional digital asset strategies with a strong focus on global capital markets. Welcome to the podcast, Ben.
Thank you very much. Thank you for having me.
Absolutely. So, Ben, you have a very, very unique profile from the folks that I know in the space. You have a very deep sort of Wall Street and capital markets background. You also have an extensive amount of experience in certain Asia markets, and you've been in the digital asset space for even longer than I have. So maybe just give folks a quick flyover of all the different things you're involved in, and maybe tie that a little bit to your background across some of the regional aspects of what we're going to discuss today.
Sure. Yeah, I will try to be quick about this. I think I started my career as an engineer, decided I want to be in finance, went to business school, and joined Merrill Lynch in Tokyo quite a while back. I spent about 12 years there. Traditional finance, ran the structured products desk across Asia, and then ran the commodities desk across Asia for them. After that, I moved over to the buy side, spent 3 years at AllianceBernstein as head of alternative investments. After that, after about 15 years of expat life in Asia, I thought it was good to come back to the States. Parents are getting older, kids are getting older also. So came back to LA where, my parents live, where I also have a house. So, been in LA for the past decade. Went down the rabbit hole of blockchain cryptocurrencies, did some nonprofit work that led me to currently teaching at the Anderson School at UCLA. I teach a crypto finance course there. And also on the professional side, about 8 years ago, met up with a number of partners and we started Wave Digital Assets. One final thing that I've recently been involved in, I'm on the board of MetaPlanet, which is the third largest stat in the world and the biggest one outside of the US.
Really awesome. So, Ben, I think where we want to take the conversation today with you is really to get, not only your perspective of where we are from a global standpoint, but also speak to specifically what you've seen based on your experience in certain Asia markets. Maybe let's start with just generally speaking, zooming out and saying, what do folks who operate, exclusively in the US markets misunderstand about maybe the Asian markets more broadly? But then when you actually if you were to say more specifically about the crypto markets in Asia, how would you articulate that?
Yeah, I think one thing I keep reminding people is that the US is one big market. And yes, you have some regional differences, but it's basically one big market and under one general regulatory scheme, and people operate in a general framework. In Asia, it is very, very fragmented. It's, there's the North Asia, there's kind of the Southeast Asia fragmentation. Within that, you got Japan, you got Korea. Of course, you have China, you have Taiwan, you have Hong Kong, you have Singapore. These are all kind of different hubs and they operate in different ways with a different regulatory regime. also the risk appetite among people are very different. You have the very high frequency trading retail of Korea versus the very conservative, high net worth investors out of Thailand, for example. I mean, they're basically only buying principal protected products. So that variety is also extremely interesting, where you have both ends of the spectrum. And the last thing I'll mention is, I think, a little bit different from the US. I think there's probably a bit more of the total assets in high net worth that's more entrepreneurial, first, second generation. These are the people that made their own money, or they've seen their parents make the money, so they're willing to take more risk. Whereas in the US, there's probably a little more on the inherited side, which they are less likely to take risks because they're just inherently more comfortable just generating yield out of what they already have.
And when you think about Asia in the context of crypto, because crypto is very much a global market, and I view it as a very global industry. It's when you travel to conferences, you're going to get folks from every region of the world that are there, no matter where that conference is being held. Is there anything specific about crypto when you look at the Asia market and you say this is sort of something that's unique to this market, or how this market interacts, frankly, with the broader global scale of other markets, geographies?
Yeah, I think the speed of interaction with crypto is very different between retail and high net worth and institutional investors and your traditional kind of pension funds and life insurance portfolios and so forth, and retirement funds. And that spectrum, I think depending on which country you're in, that spectrum is very different. On the retail side, I think there's a lot of investors in crypto, both in Asia and in the US. But within each country within Asia and also in the US, the amount of involvement on the institutional side is differing depending on the country. And I find it very interesting. It's the amount of, I think this is one of the first industries or one of the first asset classes where it's growing bottom up as opposed to top down. And because it's growing in the opposite direction, the retail speed is similar, but as it gets to institutional, though, the proliferation or the diffusion into institutional is different depending on which country you're in. So that, to me, is extremely interesting.
And you spent a huge amount of your career in Japan specifically. I don't know if you want to talk specifically to, how a technology like blockchain and crypto gets digested, so to speak, from like an institutional and even a regulatory standpoint. Can you maybe walk the audience through how you would frame that in terms of how you expect, even a specific geography like Japan to sort of adopt and think about adopting sort of a new paradigm within financial services?
Sure. Yeah. I think Japan is interesting in the sense that as everyone has a general feel for it, it's very organized. It's very structured. And for something to come in like crypto, it's something that they're trying to absorb into the logic that has been kind of in finances. Crypto started on the payment side. It's considered kind of a payment, like a token or like mileage or points. And points systems are very popular in Japan. So crypto started in that space as opposed to being in FX or being in equities or being in any other or commodities or any other bucket. So it's in the rewards bucket. I think over time, as it's evolved, the regulators have realized that is probably very limiting for it. So they're moving that actually into the security space, which I think they just approved that last week. So, that'll come into effect next year. But it's interesting. I think around the same timing, you have the SEC coming out and saying most of the major cryptos actually are now commodities and not securities. So it's interesting how things are shifting. And to be clear, in Japan, they're not saying it's going into the securities world. They're saying it's going into the investment assets bucket. And within the investment assets bucket, there are various different, sub buckets like securities and FX and commodities, and crypto will be another sub bucket there, right? I just want to be very clear there.
No, that's great. And Ben, my limited experience with, some of the Asian geographies is that also that corporates and conglomerates play a much bigger role in sort of the economic fabric and sort of the sort of like business community within, sort of the adoption of new technologies. I'm not sure if you have any sort of insight there in terms of, what role sort of large corporate conglomerates play as it relates to crypto or otherwise, and how we should think about sort of their participation or adoption of new technologies, crypto specifically.
Sure. Wave Digital Asset are just maybe a little plug for our firm. Our focus is on treasury management for some of the large protocols and foundations. So we have a lot of conversations with them with regards to each markets within Asia and so forth. So I'll talk about Japan, and this is how I typically position it for them as they're thinking about entering the market or need more assistance there. It's something that we assist. In Japan, it's very interesting. It's basically really three buckets. It's very organized. There are three buckets that you can think about as major businesses in Japan in the blockchain space. You have a bucket that is basically bottom up retail trading. It's really just retail high net worth. You don't really have a lot of corporates trading there. You don't really have a lot of institutional trading there. And they're represented by exchanges. In Japan, exchanges are also licensed as custodians, which makes total sense to me. If I'm handing a bearer instrument to an exchange, why are they not the custodian? I don't know why that works anywhere else. But in Japan, when you hand your asset to the exchange, they're also the custodian of your assets. That sounds very logical, and I don't know why that isn't true anywhere else. So that's the first bucket, and people trade there. And in a very broker dealer kind of way, if you go talk to the exchanges, the only business they're really in is the trading and custody business. They're providing some staking yield. They're really not allowed to do investment products. They're not really doing wealth management. So that hasn't grown so far. I think there will be a push into that space now that the laws are changing and that crypto is now considered an investment instrument, as of next year. So that's an area of development that I find interesting. So that's one bucket. And in that bucket, the corporates aren't really involved. The major financial institutions have not been involved, but have announced that they will be involved. Nomura has come out and said they'll get a new license. Daiwa said they're going to get a new license. I think there's currently 28 licenses outstanding, and about 10 of which are very actively involved in the trading side. So that's one bucket. I'll set that aside. The second bucket, interestingly enough, is actually NFTs. I don't know if people have reactions around the word NFT. I think it's like a word from the past almost for those of us that kind of in the US. But it is something that is still actively looked at and pursued on in Japan as part of a real government effort to look at IP exporting and so forth. And for them, this seems like something that Japan should have a strength on, and the government has come in and told the corporates, hey, this is probably something you should be supportive of, that you can go forward. A number of major firms actually own an NFT studio or NFT collection or NFT artist that's generating stuff. They're being very supportive. I was at the Japan Stablecoin Summit, and they held it at KDDI, and KDDI being one of the major communications giants in Japan, they were handing out these fancy little books as part of the swag package. And I opened the book up, it's their NFT studio, and these are the artists that they're highlighting and their art and so forth. And they actually have kind of a fan base of that art, of that artist and so forth. So it's a very different environment compared to the US, and it's a channel that's kind of government guided that, a lot of firms are actively involved in that. And that includes gaming and so forth. The likes of Bandai Namco, the likes of, Sega Sammy, the likes of Square Enix have huge VC funds that are deploying into this space really to support the NFT gaming export of IP narrative there. And that is corporate involvement, I think, as per what you were asking. The last bucket is really what is the financial side of it. And this is the side that a lot of the major financial institutions are actually getting involved at the bank side, at the security side. And we're talking about what we used to call security tokens, and nowadays we're calling RWAs. I'm dating myself by saying these older words, but the RWA side, bring assets on chain, trying to pass yield around, tokenizing that and moving that along. So that is a super exciting space. Along with that, there's a discussion around stablecoins. There's currently only one stablecoin issued in Japan called JPYC. It's by a company called JPYC. Okabe-san runs the place, and he's got investments from Circle, from various other places, including MetaPlanet that I'm involved in. And, it's the only stablecoin in yen that's available right now in Japan that's certified, able to be in circulation. But there's, because it's still part of the payment scheme, there's a cap of 1,000,000 yen a day per wallet, which is about $7,000. I mean, if you go talk to Tether people, they laugh in your face about a cap of $6,000 a day of transfer per wallet, right? Like, what are we talking about? So it is, it's scale wise, I think it's still up and coming. So they've proposed new versions of stablecoins that would fall under the securities rules that be issued with a trust bank or by a trust bank and so forth. So we're looking at the new development of that as all of these regulations move forward. And just to give you a sense of timing, the laws around stablecoins passed in 2023 in Japan. So it is taking them this long, and they haven't quite gotten it worked out. And because Japanese yen rates are low, so the incentives for doing that is actually relatively low. So
it's really fascinating to hear that also, just because so much of the zeitgeist, at least in the US, is really dominated now by stablecoins. You really can't have a conversation in the digital asset space without talking about stablecoins, whether that's from individuals, whether that's corporates, whether that's venture firms and so forth. So just really interesting that Japan has had rules on the books, but in terms of just how it's manifested itself in the economy and in sort of the broader community is quite interesting. Ben, let me ask you a question. You've obviously spent time in a variety of different jurisdictions, but I'll really focus in on really three that I think are maybe most interesting from sort of a crypto and digital asset market perspective, and wanted to get your take on how they're positioning themselves relatively from maybe a regulatory jurisdiction standpoint, or also just for an ease of doing business standpoint as you see it from a digital asset perspective. So Hong Kong, Singapore, and Japan are often held out as, these are the sort of the major markets where people are, or where companies are putting people and resources as they think about expanding their teams, something that we've thought a lot about. Do you see some nuances in terms of how those different jurisdictions are positioning themselves, and how would you frame that?
yeah, I think I'm going to make very broad generalization because we're in a podcast. We'll keep it short, and I want to say that despite my comments, it's very nuanced from market to market. So let me just kind of generally kind of comment on these. I think Japan is taking a cautious step forward, and there are a lot of detractors who don't like change in general. So the crypto ecosystem, all the ways that crypto people want to do business, it is very new. A lot of it is very efficient. A lot of it is kind of run fast, break things type of feel to it. And that is definitely not how Japan runs. So there is a natural and inherent resistance to adopt any part of crypto. So you continually kind of bump into that. But at the same time, I think there's also a part of Japan that says we were the leader in this space before Mt. Gox blew up. We want to be, continue to want to be a leader in this space. We want to do more. We want to do it in the Japan way, kind of in a regulated sense, in a way that's comfortable. So there is generally a support for new technology and doing new things, but at the same time, they want to do it at a speed that they're comfortable that they're not going to break too many things in the process. So I think that that's a good way to look at Japan in general. They've opened up certain doors. They've made progress like stablecoin regulations and so, but people are moving forward relatively cautiously. I would say the Achilles heel, I've said this just in general about Japan, is that a lot of the major firms, they transfer people from division to division every 3 years. So especially the very competent people, they get transferred to all different parts of the firm, which means the institutional knowledge doesn't stay as well as it should. And that's a really, it's a shame. It's a disappointment because a lot of institutional knowledge is lost, and it's lost, not accidentally, but it's program loss of institutional knowledge. And it's like, why would you do that? And I haven't really kind of figured out how they can kind of resolve that to a certain extent. But it's interesting to that makes it a little bit difficult, right? Sometimes when I go see senior people at financial institutions, they're very knowledgeable, very up to speed. And then a few years later, they get transferred and somebody else comes in and you start from scratch. You got to explain everything to them again. And that happens both in TradFi and in crypto. And that is disappointing. So setting Japan aside, let's talk a little bit about Hong Kong and Singapore. I'll start with Singapore. I think just from my personal views, it's actually a very interesting thing. So I lived in Singapore, before coming back to the US. And Singapore has always been a very open place, kind of almost position themselves, the whole country as a sandbox. Like, come try new things, do different things. We're here, open, multicultural, up for anything. So coincidentally, my business partner David Seymour, he ran a very large, Southeast Asia VC conglomerate out of Singapore and Santa Monica. And on the Singapore side, there's actually a lot of investors that are in his funds. And one of the sovereign entities, I won't name any names, but one of the sovereign entities out of Singapore, he approached them and said, hey, this new thing coming up, this crypto thing, we're going to start a VC fund in crypto. I think it'll be great. They basically told him, don't do that. If you did that, we'd pull all your money and never support you again. Crypto is fraud. Don't mess with it. And so we ended up building Wave Digital Assets separate from his VC fund, right? So it's interesting. Wave was built, completely independent of his traditional VC side of the business. And the VC that he wanted to do in crypto is basically in Wave Digital Assets and not in this traditional VC arm of things. And that's kind of how Wave branched off. That quite a while back. It was 8 years ago. Later on, obviously, Singapore, all the sovereign entities included, embraced, crypto as a whole, and big build up. A lot of people moving there, becoming a crypto hub, and then came through that second crypto winter where they invested in a lot of people, including FTX. FTX blew up, and many other companies blew up, and they all blew up even after they claimed they're registered in Singapore or regulated by Singapore, which made Singapore look bad, right? So you've got your Babbles, your VODs, your Three Arrow, their investment FTX doesn't make them look very good either, and so forth, right? There that whole chain of blow up, which we as Wave were not affected by, but it made Singapore regulators look really bad. So they it's really pendulum swinging the other way. They've become very much more conservative in the past few years. They've gone down. I think last year they were going through a crackdown of companies that were operating crypto for outside of Singapore but not in Singapore. So they're really trying to clean that space up. So I don't blame them. I think their experience was not very positive, and I can see how that they felt like they need to restore their reputation by being a bit more critical now. So we're kind of on that pendulum swing. So I think it's becoming more difficult there. And then we come to Hong Kong. I think Hong Kong is a tricky one because of the connection into China. China at one point kind of shut all of crypto down, stopped the mining, stopped everything. But there's kind of an underground kind of crypto space that was still in existence that people wanted to do it. They just kind of did it kind of under the waters type of thing. And then, at some point, I think China decided they were going to let Hong Kong be this crypto sandbox for all this undercurrent or underwater people to at least come out and do it in a controlled space, which I think is a wise thing to do. So Hong Kong then started going down this path of putting a lot of regulations in place to be able to get licensed, to be an exchange, to be able to issue stablecoins and so forth. So that's a very positive progress. Unfortunately, I think because of history, there is a concern with Hong Kong that what if Beijing calls and say, just shut everything down again, right? And that could happen because that happened in the mining space, right? So that could happen, and that's always a concern. And I think that will always handicap Hong Kong in a certain sense. That is always a risk that they will kind of face. So that's kind of how I'm seeing these three markets. I would just mention as a bonus, I think the Korea market has been very tough so far, but it feels like it's starting to open up. So I'm starting to keep an eye out on Korea. I feel like that's interesting. It's a huge market for crypto. It's retail only. In the past few years, they've driven all the institutional investors out. They've literally driven the Korean local institutional investors out of the market, only allowing retail, only allowing individuals to trade, which is, if you think about it, that's kind of weird, right? But that's basically what they've done. And I think they're now starting, the pendulum swing the other way. They're starting to open it up. At some point, I think they're letting the universities trade now. They're going to let, some of the financial institution trade. They'll let, kind of institutional business back in over time. And I think that's exciting. They've got custodian business going. They're in deep discussion on stablecoin also as they watch Japan's progress. So I think things are going to swing the other way, the positive way for Korea.
Ben, when maybe shifting to your sort of day-to-day and core business, maybe a lot of folks don't know, what Wave does, and maybe we want to speak to, what does treasury management mean? You mentioned a little bit at the high level of like who you service, but I'd be really curious also for you to give maybe the context of how that business has evolved and how the sophistication or sort of what treasury management means in this context, how it's evolved. I think it would be really helpful for the audience.
Yeah, I mean, I use the word treasury management because we're really dealing with corporates, but I mean, it's to a certain extent similar to wealth management, right? It's really just helping people manage their money. And we're a SEC registered investment advisor in the US. We're also registered in the BVI for our international business, and we basically help manage client assets. We only focus on crypto. We don't do equities. We don't do fixed income. We're not trading S&P or anything like that. So our focus is really just on the crypto side of things. We started by going to rich people, getting them to try to buy crypto. It would take us hours to explain what a blockchain is and what crypto is. And after many hours of explanation, the rich guy's convinced, great, I'm convinced. Here's $100,000. Let's try this, right? And it's like, if you're collecting $100,000 checks, it takes a while, right? It's a tough business to do in the way that we want to do it, where we're providing full service as a fiduciary. We're not making an upfront cut on our trades. We stand on the same side as the client to face the market. We're not the counterparty. We're not the OTC desk. So because of that fiduciary duty, it makes it very hard for us to make money from our clients. And therefore, we couldn't really service clients $100,000 at a time. It just didn't work out. So, we then went to high net worth clients that had crypto already, had decent sized positions, and some of them ended up with large positions, even though that wasn't their intent. So they needed some help managing that and so forth. So we got into that. And as we expanded, we kept going up this chain, as in who has more crypto, and it ended up being kind of founders of protocols, and then it just ended up being the protocols, right? So we manage assets for a number of different protocols. It's well known we manage Charles Hoskinson's assets on the crypto side. For Cardano, we've recently been supporting also the Night token launch and so forth. So we manage that. We manage a few others, and I'll mention the ones we've done press releases on. We manage Polygon's assets, and we manage assets from a number of places. We're obviously not the exclusive service provider, but we're one of the ones that are helping them in that space. And I think the question then comes down to, well, what do you do for them? And what we think about is really kind of a white glove private banking service, right? It's almost a joke. People in private banking say, we walk the dog, we pick up the laundry, and we get their kids into college. And that's kind of generally what we're helping with, right? So I'm speaking with Japanese exchanges to see if they're interested in listing Night, and it's kind of like getting kids into college, right? From that perspective. So that's the kind of thing we do. And the core of what we do is actually we help clients buy, hold, sell, lend, borrow, stake, do derivatives, onshore, offshore, listed, OTC, CFI, DeFi, and that's pretty much everything you can do with these tokens. We do it for their native tokens. We do it for their stablecoin collection. We invest in VC on their behalf into their ecosystem. We support their DeFi network build out, their DeFi ecosystem buildup. We've done that, for example, for Cardano. So we basically support all aspects of what they want to do. We act as their financial arm. We're not a replacement to their financial arm. We're kind of the execution arm for what they want to do. For the protocols that are more active, we're just executing on their behalf. For the ones that are more passive, we're the ones that are kind of discretionarily managing their assets to increase their yield, make sure that they have money when they want to spend money, and so forth.
What excites you most about the potential in terms of how your business will evolve in the next half decade or so, in terms of both like clients that you would be excited about serving that you think will eventually become Wave digital asset clients, and or other sort of products or capabilities that you think you can continue to launch to service your already existing set of customers?
We're very excited by this business because we're growing with our partners, right? Our partners, to a certain extent, give us a guidepost for which direction we want to go, right? In the past few years, a lot of pivot towards DeFi, towards trying to get institutional coverage or institutional adoption. We're also seeing enterprise adoption. For example, this Midnight project we're working on, there's a lot of discussion about privacy. So, we've gone down the rabbit hole of, what does privacy mean? What is that important, and so forth. And that's a very interesting discussion. It's very educational for me. It's something I'm learning a lot. about. And at the same time, we understand the importance, and therefore we build up capabilities in trading DeFi, in trying to implement, privacy. I'm also, kind of supporting that in terms of kind of enterprise use and so forth. So it's a very symbiotic relationship. We point them to the direction we think that the world is going to. They point us to the direction they think it's going to, and we kind of collaboratively move forward. So yeah, that's exciting for us.
So you mentioned your role at MetaPlanet earlier in part of your intro. Obviously, digital asset treasury companies is sort of a relatively new construct, I would say, both in terms of capital markets, but also for the digital asset industry. Been a huge growth in terms of the number of digital asset treasury companies and frankly assets associated with them. I'd be curious just to get your perspective from a very high level of where do you expect that market to go? How do you think about that sort of those types of vehicles and what they're going to look like maybe in, again, 12 to 18 months and what types of activities they're going to be involved in?
Yeah, I think people have realized that, the DApp model of just holding Bitcoin doesn't quite work very well because Bitcoin doesn't generate a yield. I think the Ethereum one, the biggest Ethereum one, I think they were announcing they collected, I think, $200 million in staking rewards or something, right? $200 million a year, you can do a lot of business, or you can have a lot of staff to not do business if you wanted to, right? So I think that having the staking reward versus Bitcoin where there's no staking reward does make a bit of difference. But at the end of the day, even that staking reward is really passive income. I think the question people are now asking, the question I get asked when I'm at shareholder meetings is, what's next? What are we doing with this, right? So from my personal perspective, I think MetaPlanet is amazing. It's got a huge and clean balance sheet. And so it's true for most of the large dApps. Huge, clean balance sheet. There isn't a lot of other things. So the question is, what can we do with that? And that's something that I think we're all exploring very much. We're starting at the bottom and kind of working our way up. We've beefed up our shareholder program. These are kind of smaller things. We've also announced at the last shareholder meeting that we could roll out a credit card. I think that's interesting. And the point of the credit card is not just how we're involved in our shareholders or we're involved with clients. We're actually doing a kind of instead of cash back, we're actually doing Bitcoin back. We're actually sending Bitcoin to people that use credit cards. The refund rate of like the 1.6% is, I think, the highest in Japan for a refund rate. And on top of that, that refund is done in Bitcoin, right? Because we believe in Bitcoin. It's very on theme for us to be able to do that. So we want to do more of that. And then the question comes down to, is there more we can do more actively? We've started a VC side. This has been announced. We've started a VC side. We've set capital aside to do venture investments. We've invested in JPYC because we do believe in payments in Japan being an important part of this. I was joking about the fact that $1 million yen cap per day, but if you're going to buy a cup of coffee, it's plenty for buying a cup of coffee and doing other basic things in life, right? Your day-to-day payments, and that's part of what it was designed for. $6,000 a day is enough for you to live your days. So from that perspective, I think there could be a lot to be done in that space. So we're looking at that and kind of heading that way. So I think just overall, I think DATs, the larger DATs who have a healthy balance sheet should look at what they can do. That's a diverging opinion from Michael Saylor, who says don't do anything with your Bitcoin. But we're looking at the possibilities.
Well, I think that also, lends itself to when you think about there's different types of DATs out there and you're, talking, very specifically to the ones that, are Bitcoin oriented. I think the ones that are, stakeable asset oriented, right? There is a really interesting, sort of what I would call yield component to being able to generate cash flow that way. I also think when you look at folks like BitMine, they've gone out and made some, let's call it interesting investments and in some cases acquisitions, maybe viewing themselves more as a, Berkshire Hathaway type model. I'm curious, Ben, as you look out there and you say, at some point we're going to look at DATs and bifurcate them into different categories. What do you think that bifurcation or that framework is going to be? Is it going to be ones that figure out how to acquire and or orient themselves around a certain set of assets that then generates cash flow? Is it something else? What do you think will ultimately define, when we look back, like a successful set of DATs versus ones that we view as either unproductive or unsuccessful?
I would say that, short of being strategy, I think there does need to be a differentiating story of why it's better to buy the stock instead of just going buy the tokens yourself, right? And that goes back to, are there interesting business strategies being done? Are there interesting cash flow businesses that are in a firm, et cetera, that would generate outsized returns and taking advantage of the Bitcoin, right? So, just not saying that MetaPlanet does this, but just a very simple comparison of A to B. Instead of buying Bitcoin yourself, if you went to a company that was leveraged on Bitcoin, then, if you want that leverage, it would be superior for you to buy that equity as opposed to buy the Bitcoin yourself, right? So, and this is on the assumption that you think the company's going to do a better job of you try to get your own leverage on that, right? And I think that is, one good way to look at that. MetaPlanet is also in Japan, so I think there's a discussion of, can we source capital in Japan to be able to provide better yields? And if we could do that, I think that would be a big advantage also, right? So these are all different things that are available out there that we're looking at, we're exploring, and nothing's set yet. Nothing's announced, but I think that the idea is to be able to do more different things. At the end of the day, if you can't do more different things, then the question is, why would people buy your equity instead of the token itself? And I think that's a tough question for people who aren't doing, other businesses other than just buying and holding it, right? So strategy being an exception in the sense that they've really figured out how to raise money, right? They're able to increase their capital over and over again, and they've built the reputation to be able to do that, and their scale is very high. When strategy goes out and buys Bitcoin, I mean, they buy like tens of thousands of Bitcoin. I mean, MetaPlanet only has 40,000, and we're number 3 in the world. We're not like tiny, right? But yeah. So, strategy buys, the size of our company in like a month or something like that, right? So it's just from a scale perspective, it's just very, very different.
Absolutely. I mean, you have, experience on sort of a global level and across a variety of different categories of digital assets. I'm curious, as you look out today and you think about what category of digital assets has surprised you most over the last year or so in terms of either its growth in number of assets or just its prominence or where it's being discussed. I'm curious how you would answer that.
I don't know the answer to this, but I'm very excited by kind of the progress on DeFi. And I think it's actually moving faster than I thought it would. I think DeFi had been a niche the first DeFi summer, and now that's becoming kind of a full-fledged business. And that's kind of generated your prediction markets type of business models. That's generated your perpetual futures markets. Perpetual futures has been around since the 80s, right? I think this was something that, equities had at one point. Nobody picked it up. And so when the crypto guys picked it up and gotten it going, I think it was BitMEX that I think started. And, it's actually very exciting that people are adopting crypto rails and crypto tools to now trade traditional finance. There's kind of trading of perpetual futures on oil and so forth, trading 24/7 through the weekend as the oil market was closed or as the equity markets closed. I was looking at FX for historical FX rates, and I was like, where are these gaps? And I looked it up, of course, it's weekends, right? So like, why should there be weekends? Well, I go shopping on weekends. There is an FX exposure, right? What are we talking about? So, from that perspective, I think, the financial world is starting to use these DeFi tools or these, kind of crypto tools to get to do what they want to do. I'm not clear as to how the bridge is going to be crossed, with regards to the regulatory side. I think there is, kind of a very wide spectrum of what is and is not acceptable. So I have been a licensed securities representative in the States and Japan and Hong Kong and Singapore and in Taiwan. So I get where the regulators in general are coming from the regulatory environment. And that a lot of that is a reflection of really the U.S. and the U.S. pressure for AML KYC, and and the U.S. really has asked the financial institutions to be the gateway for that, and that has been a big burden, and I think a lot of emerging markets have not been able to access the financial system because of that. So is it a question of loosening those gates a little bit, or is it a question of we force the DeFi system through that lens, right? Through the traditional, very, Western, or maybe very American is probably the right way to say it, very American lens of, we want the financial system to be the cops, the financial cops across the world, right? So
it's a good segue into when we think about the American perspective and the U.S. perspective. Obviously, a huge shift in the last 2 or so years, really since the last election, in terms of what the stance is on the digital asset industry, the crypto industry. Obviously, Clarity Act is still in the process of working its way through the halls of Congress. I'm curious how you see the U.S.'s role in the digital asset realm, irrespective, or maybe if Clarity passes or if it doesn't. How do you see it making up sort of the or shaping maybe the digital asset realm, both from a regulatory perspective, but also just sort of a size of the market opportunity perspective? I could make the case that the U.S. is the largest market if you're talking about anything financial services oriented, and so I expect that would have an extension to digital assets just being another asset. But how would you view it, and how would you articulate what knife's edge we're on, if any?
that's a tough question. I think the US a lot of time makes rules for the US and it impacts the world, but the US doesn't really think about the impact to the world, which is fine. I think that's the advantage of being the biggest market, right? You just figure out what you want to do. Everybody else can kind of play along, right? So I think that is the advantage that the US has always had and will continue to have. And therefore, I think the US rulemaking really, they're not looking at Europe, they're not looking at Asia, they're not looking at any other continent for advice or for guidance as to how they want to move forward. They just kind of decide and everybody has to play along. Just to be clear, I mean, this isn't just a crypto thing. Traditional finance has always been like this, right? So that hasn't really changed very much. And then on top of that, you add the IRS layer, which, kind of also messes things up, right? The world of finance before even crypto came around was, 144 and Reg S, right? So all financial products in the world are either for US clients or for international non-US clients, and you have to fall in one or the other. So there's a big Grand Canyon of a chasm in the world of financial products where, and who created that crack? Well, IRS did, actually. It's not even, SEC or anybody else. So those things, I think, you have to keep in mind. But, Asia, like I mentioned before, because of its fragmentation, no single market is bigger than the US and not even close. And therefore, as individual markets, it's difficult for them to drive a narrative away from kind of the US narrative of things. So I think that the US narrative is going to continue to drive that dialogue a lot. With that said, I think because of the borderlessness of crypto, it has consolidated, a lot of the interest, a lot of the technology development across Asia, right? For example, you have a lot of Chinese operators that are operating out of Hong Kong, out of Singapore, that have moved a little bit away from we're Chinese, and they've gone to the we're Asian type of feel to it. The Binance of the world, the OKX of the world. None of them say they're Chinese. They don't have a headquarter in China, and Binance, in theory, doesn't even have a headquarter. They're just like everywhere, I guess is how they put it. So, so that is one way to kind of consolidate markets, to bring a balance to counter kind of the size of the US. And the US crypto market could potentially be a lot bigger if there was more adoption, right? But until then, the Asia market as a whole, in a consolidated basis, like on Binance, OKX, is actually quite large, quite deep liquidity and so forth. You compare that with Coinbase, I think, it's competitive. So from that perspective, crypto is actually kind of evening the scales a little bit from that perspective. Specifically the U.S., I'm hoping the Clarity Act passes. I think there's a few more weeks of that Congress window before everybody goes on summer vacation. And, I think that they will be difficult kind of in the fall or after the midterms, for anything to get through. I'm expecting more fragmentation within Congress, if that's even possible, after the midterm. So, I don't think it'll be easy to get a consensus opinion to get something to pass. My understanding was, I think the stablecoin discussion or the yield on stablecoin discussion was a big one. And I think Brian Armstrong was pushing strongly back against that. But I think he's kind of lifted his objection and he's now supportive of the Clarity Act as far as I heard last time, but the news changes. As far as I know, as of last time that he is, supportive. So I'm hoping that there's not a lot standing in the way of getting that passed. I think it'd be very important to get that passed because I think once it's in place, it's much easier then for people to move forward, regardless of, whether it's Republican or Democrats in the legislation, because that specific law is kind of set on the ground, and then we lean more on the judicial side as opposed to the legislative side to give us guidance for how to move forward.
You spend an inordinate amount of time discussing and educating, both in the classroom, it sounds like, as well as with potential clients and investors, teaching them about what's going on in the digital asset space. And you gave the story earlier that you spent hours with individual investors for a $100,000 check and getting them comfortable with what is a blockchain. What do you find is the sort of educational barrier? What do you spend your time explaining more and more to folks that are either on the institutional investor side, or frankly, that you think of when you think about your classroom? Where do people have the most questions and blockages as it relates to understanding the technology and the applications?
I am always struggling to simplify the story. I think I've been, in general, pretty good at summarizing and simplifying the story. And in traditional finance, I think I've kind of honed that down pretty well. But that comes from typically talking with other finance people where there are certain layers of understanding. Like, I'm not explaining what an interest rate curve is. Everybody knows what an interest rate curve is. I'm not explaining what commodity is and why is that different from equities. Everybody knows that. But when you get into crypto, there's so much basic foundational stuff that you want to get through before you tell them your wonderful, amazing idea. The light bulb can't come on until they understand why that is unique or that's different, right? And that is a struggle for me. On top of that, I think I also struggle with sometimes the foundation is not the same foundation. Whereas I think in finance, when I say yield curve, you're like, yeah, we're talking about the same thing, right? But when I talk about some other stuff, sometimes there's a gap in understanding in crypto in terms of the language used and so forth, right? As an example, there's native staking on Ethereum, there's native staking on Cardano, and then the DeFi people decided to adopt the word staking for the liquidity provisioning. So all of a sudden you got liquid staking. It's like, wait, is that staking on protocol? No, it's a different thing. But it's staking. You get something, and therefore it's staking. People decide to adopt their own language, adopt their own vocabulary, makes it very, very, very difficult, right? And on top of that, you have protocols who are trying to be cute, right? Tezos, they call the staking a baking, and the people that are staking, they're bakers. It's like, really, do we have to go that way? And there's just a lot of that, I think, all around. I get that we're all creating new things, so people get to pick whatever vocabulary they want, but that does hinder communication, right? It's difficult for me to put multiple layers in and have that conversation. And I hate to say, sometimes I just kind of give up. It's like, it takes me too long to give you the background in order for us to have this conversation type of thing, right? So, which is not good, I think. Yeah.
No, I agree. My penultimate question is, can you think of or name either a founder or a project that you think no one is talking about but should be, or we should expect to hear about them in 12 to 18 months because they're doing something really special?
I'm going to name kind of the obvious. I think the person of the hour really is Jeffrey Yan over at Hyperliquid. There was an article that came out, I think, 2 days ago on Colossus, and it was an excellently written article. And it really highlights, I think, what I've been saying before also, that I think crypto has been built by engineers who decided not to worry about regulations, just say, hey, what can we build that would be the most efficient thing? I don't care about broker dealers. I don't care about asset managers. I don't care about fiduciary duty. I don't care about, regulations. I don't care about onshore versus offshore. Hey, let's ignore taxes also, right? Let's not talk about Reg S exemptions. Let's not talk about blue sky laws. Let's pretend I don't know anything about these financial regulations. Okay, I'm trying to do a transaction. I'm trading with another person, A to B. What is the most efficient, clean way to do it that is fair for everyone? And let's go build that. And to me, that's kind of what Hyperliquid is trying to do, right? As a protocol. And within that, the Hyperliquid exchange is a pure form expression of that. It's grown a lot in value, in volume. It's grown a lot, and it is built from somebody who already has a lot of money and is not building this so they can make a lot of money out of building this. They're building this out of a belief and understanding, right? And I find that very impressive. And obviously, that you have to start with having a lot of money in order to be able to go down that path, but it's still very impressive. It's a little similar to Charles in launching Midnight. He basically built a new blockchain with his own money. I think it was like $200 million, 6 years of his life, and he's just giving it away. No ICO, no sales, no VC involvement, and so forth. It's a beautiful, clean way of launching a blockchain. And after it's launched, you don't have VC dumping tokens. You don't have other investors coming in dumping tokens. It's great. But it requires you to start with 200 million in order to, and a number of years to be able to build a blockchain to cleanly give it away, right? So, from that perspective, I find it extremely interesting. And, I think it's, I highly recommend for people that haven't seen the article to go read the article and so forth. And I feel like an underachiever. I read a lot about Asian Americans from Silicon Valley. Like I went to UC Berkeley, right? And, a lot of Asian Americans in Silicon Valley who have done very well, right? If you've got the NVIDIA story, you've got the Hyperliquid story, you've got 10 million other stories. Like I need to work harder. So, yeah.
I think you've done all right, Ben. So Ben, we ask all of our guests for their high stakes hot take, which is their boldest prediction for the crypto industry in the next 12 to 24 months. What's your hot take?
What is my hot take? Actually, that one is a tough one. I think one thing that I think people are underestimating is the possibility of using tokenized MMFs as stablecoins.
Where do you see as the maybe the hindrance to that happening in a way that's broad based?
Yeah, I mean, it's just these pestering things called regulation that may get in the way, but like assuming that wasn't really in the way, I think this would make a lot of sense. So as an example, you and I are transacting in dollars, we buy coffee and so forth. Instead of a dollar, what if I can buy with a tokenized MMF, right? Like I can pay using my MMF, and that means that money is growing the whole time, right? The whole idea of my checking account, my cashing account being separate, it's like, well, why do we separate them? It's just an account. I don't care. I want to write checks from it, and I want yield on it, right? And I want very high yield on it, or I want like MMF level yield, and I want to write checks on it, and I want to spend it off of my credit card and so forth, right? So conceptually, I could see that being a very interesting way of operating that, and that's that I haven't really quite figured out how to get everything going. I know that there are a number of tokenized MMFs in the US. I think in Japan, they're also trying to create that. But most tokenized MMFs you look at is for qualified purchasers at very large sizes and so forth, right? I think they have the opposite problem of JPYC, of that $1 million cap. These guys are like, oh, you have to have $5 million assets to begin with, and then you can buy the stuff. It's like that's I'm not going to use that to buy a cup of coffee then if it's at that range, right? It's a very different conversation.
Well, let's park it there. Ben Tsai, managing partner at Wave Digital Assets. Thanks for coming on, Ben. We really appreciate it and looking forward to having you on again soon.
Great. Thank you very much.
That's a wrap on High Stakes, the podcast where Web3 meets the real world. For more insight into how blockchain and AI are reshaping institutions, head to validationcloud.io and follow @validationcloud across all socials. Stay tuned for more conversations from the front lines of innovation. I'm Alex Nwaka. See you next time.